Hello and welcome to this video on the actual Hungarian covered bond regulations. My name is Gyula Nagy. I am the CEO of Takarék Mortgage Bank. In the Hungarian banking sector, only mortgage banks are entitled to issue mortgage bonds, in Hungarian called jelzáloglevél. Mortgage banks are specialized credit institutions in Hungary whose business activity is restricted in principle to mortgage lending, mortgage refinancing and auxiliary financial services. Presently, there are 5 mortgage banks active in Hungary. Mortgage banks can grant or refinance financial loans secured by mortgages on real estate property located on the territory of Hungary and other European Economic Area countries. Loans secured by residential real estate can be taken in cover up to 70% of the mortgage lending value of the property. In case of loans secured by commercial real estate, the limit is 60%. The amount of loans granted or refinanced in other European Economic Area countries cannot exceed 15% in the total loan portfolio. LTV calculation for mortgage banks is based on the mortgage lending value. The methodological principles of determining mortgage lending value are set forth in a special regulation. The regulation provides that mortgage banks shall prepare procedures for determining mortgage lending value, and the procedures need to be approved of the Hungarian Financial Supervision Authority. The person determining the mortgage lending value must possess a certificate in real estate appraisal and agency, and there must be independent from the lending process. When determining the mortgage value, they cannot consider any speculative element and must document the mortgage value assessment on a transparent way. All the mortgage bonds of a single mortgage bank are covered by the same one single cover pool, which is only open to changes with the prior permission of the coverage supervisor acting in the interest of mortgage bond holders. Ordinary cover assets can be loans secured by mortgages, independent mortgage liens, or by mortgages and joint and several surety assumed by the Hungarian state. Supplementary coverage may exclusively consist of eligible liquid assets listed in the Mortgage Bank Act. The share of ordinary collaterals may not be less than 80% of outstanding covered bonds with the remaining maturity of more than 180 days. A minimum of 2% over-collateralization is required by the amended Hungarian Mortgage Bank Act. Mortgage banks shall ensure the existence of cover assets for their mortgage bonds at all times, in nominal, but also in terms of net present value calculation basis. The amended Mortgage Bank Act provides that mortgage loan companies shall at all times have sufficient cover assets to ensure that all liabilities of the mortgage bonds are covered on both nominal and net present value calculation for A, the obligation for payment of the principal amount of outstanding mortgage bonds, B, the obligation for payment of any interest on outstanding cover bonds, C, the obligation attached to derivative contracts, D, the expected costs related to maintenance and administration for the winding down of the mortgage bond program, that is 1/1000 of outstanding cover bond volume. The provisions for net present value calculation and the methodology for the related stress tests has to be submitted to the Financial Supervision Agency on a regular basis. In the case when mortgage bonds and their coverage are not denominated in the same currency, the mortgage loan company is obligated to hedge the currency exchange risk by entering into derivative transactions. In order to cover the net liquidity outflow, the mortgage bond program shall contain a cover pool liquidity buffer, composed of liquid assets. The cover pool liquidity buffer shall cover the maximum cumulative net liquidity outflow over the next 180 days. The new Mortgage Bond Act defines that a mortgage bank may issue mortgage bonds with extendable maturity if the requirements of the Act are satisfied. The extension of the maturity may take place only once and may not exceed 12 months. Mortgage banks shall appoint a coverage supervisor who shall monitor and certify that the necessary collateral for mortgage bonds is available at all times as required. The appointment of a coverage supervisor takes effect subject to approval by the Hungarian Financial Supervisory Agency. According to the law, only auditing firms having the necessary qualification may be appointed as coverage supervisor. In case of insolvency, a dedicated cover pool administrator will be nominated to the mortgage bank to safeguard the interest of bondholders and derivative partners. The cover pool administrator cannot be identical with the insolvency administrator of the mortgage loan company. Hungarian mortgage bonds comply with the requirements of Article 52 in parenthesis 4 UCITS, as well as with those of Article 129 in parenthesis 1 CRR. The amended Hungarian Mortgage Bank and Mortgage Bond Act provides now full compliance with the European Covered Bond Directive. The covered bonds issued under the amended Covered Bond Act qualify both for the European Covered Bond and for the European Covered Bond Premium logo. And finally, I would like to thank for all the colleagues in Hungary, both from the mortgage industry, mortgage banks and Hungarian Banking Association, and from the regulators and the supervision side, who participated in the preparation of the new Act. I would express thanks to the ECBC for providing us the opportunity presenting this video. For more information on our cover bonds, I suggest to see the ECBC Factbook latest 2022 edition. And thanks for your attention.